Let's go over 20 stocks that are expected to rise the most over the next 12 months. What's going on, everyone? My name is MetaMatt, and let's talk about the fact that the S&P 500 is up 8% since June 16th, when it closed at the lowest point this year. The S&P 500 is still down 17% this year. However, analysts are saying that they expect it to start to recover and then rise as high as 21% over the next 12 months. Now remember, we're talking a year out, so don't expect any big moves up in the near future, as I am still bearish on the S&P 500 for the next few weeks due to the chart setups, as I went over in my video yesterday. After all, these same analysts have stated that although they've seen patterns that show that the first half weakness this year will likely be followed by a stronger second half, they are also expecting weakness into late Q3. So like I said, we're talking long term here. So let's go over the list of 20 S&P 500 stocks that analysts are saying will perform the best in the next 12 months. Here's the first batch. First up is RCL, Royal Caribbean Group, which analysts are saying has a 12-month upside potential of 119% gain. This stock is down over 50% this year. RCL is a cruise line, and we've been watching those very patiently for turnaround. They've all taken a pretty significant hit since COVID. NCLH, being Norwegian Cruise Line, and CCL, which is Carnival Cruise, are better opportunities in my opinion, mostly due to RCL having a rough cash position with fewer assets than liabilities and hard sell-offs recently. It is currently at a historical support level, but needs to hold or it could drop down into the lower $20 range. But if we can see a resurgence in travel and luxury cruises, and this gets over $50, we could see some more future growth, but they need to sell inventory at some point, which is the more realistic scenario. It is owed some recovery, however, that is not guaranteed in this type of market. Dish is in a similar position as far as the chart goes, but has more room to run than RCL in my opinion. Dish is heavily institutionally owned and has earnings coming up next month, so that's worth a watch. Fewer assets and a lot of liabilities makes this one a cautious trade though. Warner Bros, ticker WBD, is heavily diluted, so it's not likely to respond to catalysts well, and is not institutionally backed. It has a decent cash position and enough assets to cover their liabilities. This is one we've been trading the smaller legs of on lower time frames, but I personally don't see a big reversal confirmed here yet. Analysts are saying this has 106% 12-month potential upside. CZR, which is Caesars Entertainment, is in the lower half of a good channel and has been great for trading volatility. Until it breaks this channel, there's not much opportunity for us short term. It has recently broken out of a resistance line, but has a longer, stronger one on the higher time frame to contend with. Also, is not in a great asset to liability position, but it is very heavily institutionally owned, so this one is a watch for sure. Analysts say we can see as high as $29.78 over the next year, and 94% share the buy ratings long term. As you can see, ENRC also has a high buy rating at 96%. And analysts are giving Meta, formerly known as Facebook, a high of $260.68 as their 12-month potential. This one has a gap to fill with bullish divergence, but should have pushed up already. They really do have the setup for a bullish turnaround, and a pop of volume would be great, but has had setups before and did not deliver. Maybe earnings tomorrow will be the catalyst that finally does that. Signature Bank SBNY is the only one on this list with a 100% buy rating. This one was trading at $300 at the start of this year and is currently at the $170 range. However, it was trading at $70 back in late 2020. If you want chart breakdowns on any of those stocks, feel free to ask in our trading Discord. The link to that is in the description of this video. But before we go, let's go over two other stocks that are not on that list that I see some long-term potential in. First up is VZ, Verizon. This one is a great, safer stock for your portfolio. If you're looking for a company with a great dividend yield percentage, look no further than Verizon. They have a 5% yearly dividend, around $2.50 yearly per share that you own. It is 65% institutionally owned, and the gross margin is 57%, which is solid. Looking at the chart, we are holding a strong trendline support area bouncing off the $43 level after the release of earnings late last week. If we hold this area, I think we could see some consolidation before the next leg up, which I'm aiming for $46 as a first target, then $48 as a second target. This is a stock that doesn't move too much short term, so it is more of a longer term swing, say a 6-month hold for maximum profits. In the meantime, just keep collecting those dividend payouts. On the negative side, there was a few downgrades from analysts, but from current stock prices, there is still a 20% potential upside to reach those price targets. Another great long-term stock is KULR, Kulr Technology. They found a support at the $1.22 area in the past and are now trying to hold the new support in the low $1.40 range. This is a solid company that has partnerships with Lockheed Martin, Andretti Racing, NASA, and more. Elon Musk just recently said that he believes lithium is going to be like liquid gold in years to come. Some experts are concerned there won't be enough battery-grade lithium to go around, as lithium prices have risen nearly 400% in the last year due to the electric vehicle boom. Car manufacturers are now cutting deals to go straight to the source to get their own supplies. This is a great time to look at EV companies as well as companies that deal with lithium batteries, such as Kulr Technologies. Kulr has safety performance solutions for electronic and lithium-ion batteries that have worked for NASA in space, and they are now taken to the world of electric transportation, energy storage, battery safety, 5G infrastructure, aerospace, defense applications, and the metaverse. They are heavily shorted, however, the bears can't stay in control forever, as we saw with AMC and GameStop. Remember, always do your own research. This is not financial advice. No one cares about your money more than you, which is why at PB Alerts, we teach people how to trade instead of just telling them what to buy. So if you're new to trading, my advice is to find education before jumping into the stock market with your own money, and never trade with money that you cannot afford to lose. I hope to see you next time, but as always, until then, I hope that you all make some bread.